Should you tax loss harvest or not? That's what we're going to talk about in today's episode of Joe Knows Retirement. And this is a fun topic. And this is something that we see a lot of DIY retirement planners get wrong when they try to do it on their own. And it may not necessarily mean that they're doing it wrong. They just may not be doing it completely right and missing out on some opportunities. And one of the things we hear often is, I don't know what I don't know. And this is one of those topics that we see pretty frequently. So we're going to break this down. We're going to talk about who this really applies to, who it does not apply to, and some of the things you really need to pay attention to when you are doing tax loss harvesting on your investments. And so that's what's in store for today's episode.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So let's first start off with the video here today to understand the value of tax loss harvesting in itself. And so Vanguard actually has done a study on this. I've actually done another video on this concept that basically says that 1 to 3% is what you'll do with a professional investment management team versus just DIYing it yourself. And I think that is so true. And I would even believe that to be even more than true for some of the times that we see and what we're able to do to add value for client situations. So we always recommend those that are DIYing their retirement to look for investment management help. And, if you're not looking to pay that full 1% fee to get complete comprehensive planning on your retirement, maybe you've already got tax planning in line, maybe you already have all your estate planning tax efficiently done and you feel extremely confident about that. We don't see that very often, but if you do, then maybe you don't need that full service help. We would still recommend you look to at least get tax planning help or tax loss harvesting, especially if non-retirement accounts, to make sure you can do that tax efficiently, because the alpha in just the tax loss harvesting, some people argue it can be 1 to 2% per year just for that. And then as I mentioned with Vanguard, they say they think it's going to be 1 to 3% with tax efficiency, as we're talking about here today. Also by just following market trends, rebalancing at the right times, but also behavior finance. So many times people want to get emotional with their investments. So working with a professional team can help you there. So this is something that you can do on your own. This is something that you could do with just an investment only firm, maybe save some money, or you could look to do a comprehensive team, like ourselves or someone like that to get this type of help. But the value is tremendous by understanding the ins and outs, and that's what we're going to break down here. So one of the reasons why DIYers get this wrong is because mostly in their non-retirement accounts, they mostly have mutual funds or, ETFs, and they're not being tax efficient with how they're managing them. They're not, they're just kind of buying and holding, which is a great investment philosophy to have. That's something we believe in, but we maybe want to be able to be a little more diligent there when making these decisions on the investments. And, for example, let's say I own Pepsi stock. Well, if Pepsi goes down, then that could be a great opportunity to buy Coke and write off those losses to be able to offset any other capital gains or offset at least $3,000 a year of ordinary income that I can carry over for the rest of the time. And so that can be a really advantageous thing that, hey, maybe the soda industry is down. Well, then that may mean that we don't want to sell off when it's low because it could come back moving forward. So that's why maybe we buy something that also is down that's going to have the same type of upside moving forward. This is something that we did during COVID quite a bit when a lot of those types of stocks were down during that time, but expected to come up, especially like oil and things like that. The other thing that we see that you can maybe be able to do efficiently, whether you do this on your own or with a team, is to make sure you're looking at your DRIPs, your dividend reinvestment plan. And so a lot of times people have these investment accounts and they're just reinvesting the capital gains and dividends that come off of those investments. And although that may seem wise to do in a retirement account, it may not be as wise to do in a non-retirement account. And the reason why is because you could easily saturate those holdings by continuing to grow and compound. And now maybe you're not as diversified. You may have more of your investments all in one bucket versus having a diversified approach. And obviously, the time tail strategy of buy low, sell high. Well, if you are consistently, this investments continually grow and you keep investing back into it, you're going to miss opportunities when investments are lower that you could take that dividend reinvestment instead of going to there, have it go to cash so you could reinvest it in the stocks that maybe aren't as doing as well right now that are projected to do better down the road. So just something to think about to be more tax smart with your planning. And especially when we do tax loss harvesting for clients, I mean, sometimes we may look to own hundreds of individual stocks in one portfolio, or strategically manage ETFs within that are very passive and don't trade as much or don't offer as many dividends, so that we can be really strategic in making sure that that growth over time is going to be there without having what we call phantom gains. And phantom gains are from mutual funds specifically, and that's when you have those capital gains and dividends that pay out throughout the year. You have no control over them because the investment companies are selling off those investments, and that's where you get the surprise bill at the end of the year on your tax return of all these dividends, and you weren't expecting it, and now you could force yourself in a higher tax bracket or higher Medicare premium tiers, and or it's going to mess up with your Roth conversion plan. So we like to try to get ahead of that by being efficient with stocks, ETFs, so we can have more hands-on experience there. But this is something I think is really important to understand. It's really important to own lots of different options. And the reason why is so that you can be more strategic on which ones you buy and sell. So for some of our clients, we're looking at this stuff daily, and not only daily, but throughout the day, we're looking at what should we buy and sell from a tax efficiency standpoint. Most DIY-ers are not necessarily doing that. Again, buy and hold strategy is what they're doing, which may be good for growth over time in the marketplace. And for us, we don't try to time the market, but we're just trying to be tax efficient whilst keeping our risk level and the diversification intact there. So we're not looking to necessarily buy Amazon instead of Apple because the earnings projection looks incredible. That may be part of the strategy, but it's more so about the tax efficiency of it as well. And so looking at all those different things is where you can really get some value with tax loss harvesting. But if you're only looking at your investments every month or every quarter during this type of strategy, you're going to probably miss those opportunities. There's so much volatility during a year with investments. Some go up and down very, very quickly, as we see very often. If you just look up any stock, you'll see what I'm talking about. And so when you see it go up and down, when it goes down, those are opportunities to sell. When it goes up, you understand how that works with the tax loss harvesting, so we can offset those gains. So it can be very, very valuable. Now, the tangible part of this that I always think is very valuable is you really want to, in certain scenarios, the tax loss harvesting can make more sense than others. So the ones that it can make really good sense for, one is those who are charitable minded. So if you have non-qualified investments and you plan to give to a donor advised fund or give more to charity, then you really want to lower that cost basis as low as possible so that you can take that and then move it to a donor advised fund. So you get to write off all the losses, and then you are going to have a huge gain. So tax loss harvesting can be considered of kicking a can down the road, and that could be true. You're getting your tax savings now, but if you sell that investment, you're going to have to pay taxes on it, and it's going to be even a bigger gain to recoup all of the losses. Well, what people do to maximize this is give to a charity. And so giving to a charity, for example, if you give a stock to a charity, it's tax-free. All that growth is tax-free. If you move a stock to a donor advised fund, it's tax-free. And so we do that with a lot of our clients. So we get both benefits. We get to harvest the losses, and then all the gains are tax-free. So something to really consider for those types of people, so you can be really strategic with your charitable giving. Another reason this is really valuable is for those who don't plan to touch these investments, and maybe they want to leave a legacy to their children or their spouse or whoever it may be, because there's what's called a stepped up basis with non-retirement accounts. And so how this works is, let's say you bought a stock for $50,000 and now it's worth $100,000. Well, when you pass away, your children, for example, are going to receive this $100,000 without any taxes. That's a great benefit to have. That's where the stepped up basis comes into play. So what we typically do with clients who don't plan to touch it and want that to be their goal, we again drive down this cost basis by tax loss harvesting, get all of the write-offs now. Now maybe their $50,000 cost basis is down to $40,000, right? Because of tax efficient planning. In that case, now we can offset $60,000 of capital gains versus the original $50,000. So that's how this strategy can be very useful moving forward there. Now let me make sure I really emphasize this point too. This strategy is very useful for those with large amounts in non-retirement investments. So if you're thinking I have $250,000 or $500,000 or more in non-retirement, so that would be outside of an IRA, 401k, 403b, 401k. This is going to be a very useful strategy. This is a very useful video. Now, if you're watching this and you have all your assets in retirement accounts, you're probably not going to get any use out of this. And the reason why is because with retirement accounts, you can buy and sell as much as you want in there, and there's no no taxable events until you actually take the money out of the account. With non-retirement, it doesn't work that way. Anytime you want to change an investment, that's a taxable event, whether it's good or bad. And so that's why you have to be ultra tailored and specific on this side of the plan. You can do your buy and hold strategy more so in a retirement account than you can in non-retirement. So I hope that helps give you a bigger picture of who this is an opportunity for and who it isn't. But especially when you have larger amounts, then there's going to be a lot more opportunities for you there. This is also a great opportunity. I mentioned it earlier, but anyone with mutual funds in their portfolio. And the reason why is because of those phantom gains we talked about earlier, but also the fact that you're probably going to have some added costs in there for the investment management internal expenses that you have. And you can type in your ticker symbol online and you'll be able to see what the cost of that fund is. And a lot of time between the cost and the added capital gains distributions that you have no clue of, and it happens at the end of the year, so you can't necessarily plan for it, it's going to leave you in the dark really and unsure of how to plan for that. So what we do with a lot of our clients in that scenario is first look at what is the cost basis of a portfolio. And I'll kind of give you a rundown of what we do for clients when they move over their assets to us to work with. We first just move everything over in kind. So we want to see everything how it is to with us, because if we sell everything off, it's going to be a huge taxable event. So we move it over exactly how it is. We invest the same way their advisor was or how they on their own. And then from there, we look for strategic ways to reset the portfolio. Maybe they have an old mutual fund that doesn't have any gain. Maybe because of all the dividends, capital gains, their cost basis is even with the market value. If we sell that out, there's no taxable event. Or maybe there's a mutual fund at a loss where we can capture that and then look to diversify maybe into ETFs or individual stocks, as we talked about earlier, for more tax efficiency. And so that's where we start. And so if you're the type of person that maybe you had a huge gain in some stocks, you've had stocks forever, it's going to be a lot harder to sell off these investments without any huge taxable events. And so in those cases, we can look at the DRIP that we talked about earlier, the dividend reinvestment. Instead of continuing to pour into this fire, let's take that and put it somewhere else. So that's going to help us, be able to moderate, keep this moderated as time goes there. But another thing is looking at more tax efficient strategies. We can look at a donor advised fund we talked about earlier. If you have a highly appreciated non-qualified, great opportunity to move it over, do your charitable gifting out of the donor advised fund. And I've done some other videos on this concept, really valuable if you're charitable minded. But maybe you also look at something like a charitable remainder trust if you really have a lot of gain. And this could be for non-retirement investment accounts, but also for maybe real estate that's highly appreciated, maybe a rental property or other assets that you may own. And with this is something where you can get income for life, and then the remainder, whatever's left when you pass, would go to a charity. But the benefit is you get the tax savings up front. So we've seen people and clients that we work with that have done this, and they're not even charitable minded because of all that tax savings up front and that income stream that you'll get off of this as time goes. So something very valuable to think about if you are in that highly appreciated asset category. And another part of this tax loss harvesting, let's say you have this stock you've owned forever and it's highly appreciated, and then you have all the rest of your portfolio. Well, what we would look to do is really try to tax loss harvest on this side. And something we could do with that is take the losses from this side, and then we can offset some of the gains here. So you're not ending up paying any taxes, but you are diversifying out of that highly appreciated asset. Because a lot of people don't like to have all their eggs in one basket. And so if you've got $500,000 in one stock and you've got 20 other stocks over here within your non-retirement account, let's start to try to see what we can drum up here so that we can start to take some chips off the table there without having to pay any significant taxes. So that's something we also look at in these types of scenarios, and that's where also a tax loss harvesting could be beneficial. So maybe you're not necessarily writing off the loss each year and taking that $3,000 to your ordinary income, but you're offsetting this highly appreciated stock, which can be just as valuable for you. And understand, on that $3,000, that's the most you can write off per year. So let's say you had $10,000 of losses and you had no capital gains to offset it. Well, in that example, you could write off $3,000. So if your income is $100,000, well, your income's now only $97,000. And then you can carry over the rest of that $7,000 for the next year and the year after and the year after is how that works. And so if you have too much losses, you may never be able to use it, depending on how many years you have left in you. But that is something that we want to plan for. So you can either offset gains or offset income each year to a limited amount. And we'd ultimately love to offset income for most people that we work with, because income is more than capital gains. So if you're in the 12% tax bracket, you're in the 0% capital gains bracket. If you're in the 22% tax bracket, you're only in the 15% capital gains. So You know the math. I'd rather write off 22 than 15. So that's why the ordinary income can be extremely valuable. And that's also, they understand too, this strategy with capital gains is going to be very valuable for those who have higher incomes in retirement or higher net worth. So most people watching these videos are in that 2% club with a pension, million plus saved. They're going to have a high income. They're going to have a high net worth. They're probably going to push themselves out of that 0% capital gains bracket. So anything that sells off in their non-retirement accounts is going to become taxable at that 15% rate. But if you don't have a pension, or you know someone without a pension, or they don't have as much saved, this tax loss harvesting may not matter as much to them because they can just sell off the gains every single year at 0%, and then they can keep their cost basis higher as time goes. So another consideration there to think about. And another way that tax loss harvesting can be valuable is if you're looking at doing significant Roth conversions throughout your years. And, if you have these non-retirement investments that are spitting out this dividend and capital gains every year that we're talking about, that's going to leave you less room to Roth convert. But if we can be more tax efficient in our non-retirement accounts, then that's going to allow us to suppress that gain that we may see each year and allow us to now convert and use the income there rather than paying these dividends and capital gains. And so that's something we've seen to add a lot of value in their future tax planning by being able to do more now by being more aware of this situation. And so those are the main things to think about when you look at tax loss harvesting. And I'll have to put it this way: if you are currently not tax loss harvesting, you have a significant amount saved in your non-retirement account, you're probably missing out on opportunities. And so highly recommend you take a closer look at this, making sure you know what's at your fingertips. You don't know what you don't know. So make sure you do a deeper dive. And I hope this video did a great job of uncovering that for you. And if you watched to this point and you're looking for this type of help, you maybe have been watching these videos for a while, or maybe you feel like I'm talking just to you. Maybe you have a pension, maybe you have a million plus saved, maybe you have a significant non-retirement account there that is needing of some tax planning. Feel free to reach out to our team here. This is what we do. This is the people we serve, and we'd be glad to have a conversation with you there. So if you go into the description below, you'll be able to click a link that goes to our website to schedule a time with us there, and we'll see if we can serve you ongoing there and see if we could be a good fit. So with that being said, that's all I got in today's episode of Joe Knows Retirement.